we've started to see little sprouts of decoupling, where Bitcoin starts reacting in a completely opposite way to stocks. Bad news in stocks, Bitcoin booms temporarily. So I don't know, there is a growing part of me that thinks, yeah, if we have even more bank collapses or bailouts or whatever, everything may have like an initial shock and everything goes down 10-20% in a day, but then people go, shit, I can't even trust my banks, my money in the big banks like JP Morgan anymore or wherever. Where can we go? Not just in America, people in Argentina and other places, they may just go, screw this, yeah, Bitcoin. And it turns out the big boys, especially Jerome Powell, says that the NFTS is one of the best forward indicators of economic health and also forecasts. So if you go to the Fed website, this is quite interesting because they, on their own site, and again, if you go through the full paper, which is about 12 pages long off the book, 20, sorry, the other one I think was 12 pages, 11, okay. Yeah, I read through this one, not the bigger one, but the gist of it is basically I'll read it actually. The latter can be interpreted as a measure of the market's expectations for the near-term trajectory of conventional monetary policy rates. Its predictive power suggests that when the market participants expected and priced in a monetary policy easing over a subsequent 18 months, a recession was quite likely in the offing. We also find the near-term spread predicts 4-quarter GDP growth with greater accuracy than survey consensus forecasts, yada yada, and it has substantial predictive power for stock returns. So in a nutshell, what it's basically saying that the NFTS is very good at predicting what the Fed is going to do for interest rates in an 18-month over an 18-month period. Okay, so when we look at this, and then you find some of the websites. So here is one website, neartermforwardspread.com, and it gives you a lovely looking chart. And we can see it oscillates like any chart does. And I've just bunged it on this page here. So if we just enlarge this. So as I wrote here, basically the way to interpret this is that it's the expected 3-month US Treasury yield looking 18 months out relative to the current 3-month yield. So what this means is that if the current yield right now for the 3-month is 5.217%, and the NFTS is posting a minus 1.8 as it is right now. So if we, I'm going to end up with a million different tabs here. So let's just keep them all on one tab that I'm going through. So if we look at this, it's 1.89, 1.9. So what this basically means is, so I've gone for 1.8. So you do 5.2 minus 1.8 equals 3.4. So in a nutshell, what it's basically saying that for US interest rates, let's keep it on one tab, Siam, they are somewhat saying that over the next 18 months, they're expecting rates to drop down to about 3.4%, because that is the delta, as in the difference. So 3.4% for Fed funds is around here in 18 months time, which is pretty freaking near, pretty close when looking at this chart. And if you then look at the trajectory of it, it's likely to be one of the fastest rate drops in recent history. So this is quite interesting. Now, the way when you're looking at this, one way to look at this is see that 0% line. If you were to draw, can I even draw straight lines with this thing? Ruler. How do I do this? Do I use my mouse? Yes, I do. Here we go. Let's get it to 0%. And let's just draw a straight line. This is weird. I'm learning something new. Let's try that. Oh no, that moves the thingy. Can I draw a line? Hey. So, effectively, anything sub 0% shows great times of economic stress, whether it be mortgage, banking, whatever. And if you look at all of the big crashes in the past, every time we've gone minus 0%, i.e. the near-term forward spread has gone negative, it indicates that the Fed is going to be dropping rates pretty fast. Now, in the cuddle, and we've mentioned this quite a lot, you guys already know that when the Fed drops rates fast, what happens? We enter an economic recession. So they drop rates really, so it rose up into the crash, paused for a bit, but as soon as they started dropping rates, guess what? We had the 2008 subprime mortgage collapse. Same thing with the corona bollocks. So the tech bubble pop. 1992, when we had the UK dropped out of the European rate mechanism, and we had 87 wasn't quite, mind you, that was more of a flash crash, but same thing. We already know a fast dropping rates equals crash across the board. And so if we go back to my little doodle thing, so this chart is effectively forecasting what interest rates are likely to do, and therefore looking at this chart, this is worse than it's been in 40 years almost, way worse. So the metric is signaling a way worse outcome than 2001, 2008, and it's not looking good. That is the short of it. So as it says, as I wrote here, inverted yield means big institutional investors are anticipating that the Fed will drop rates fast. And looking at this, when you do the maths properly, which I did do, which I wish I did a bit better with the numbers here, it should be a really fast drop. The bigger the invert, the bigger the potential anticipated Fed drop. So we're in pretty dangerous territory right now. Things are looking pretty ropey. Whoopsie daisy. So if we go back to this page now, so this is just a chart of current rates, so 5.19, and then you can just minus that by, so that delta is always going to change on a daily basis, and so that is that. So moving down, this is it's quite telling. So we already know of the charts that I've shown in the cuddle with unemployment, interest rates, inflation, etc. Everything is leading up to a big old crash. And so how do monetary and economic conditions compare now to 2008? Well, it's in a worse situation because in 2008, we were coming off the back end of the roaring 2000s. So quantitative easing was effectively, properly sort of christened and born in the exit of the tech bubble pop. So they tried to reinflate the economy with QE. And so we had the roaring 2000s. And so when you look at US M2, it was pretty booming. So too many charts. Let's get rid of that. So US M2 was booming quite a lot, all the way up into the subprime mortgage collapse. But guess what? The M2 never collapsed. It simply paused for a bit and then just continued going on. Now we're in the first time in US history where M2 is contracting at a pretty fast rate. I mean, that as a percentage rate is it is literally unprecedented. And I hate even using the word unprecedented these days because it's said quite a lot. And also when you can compare that interest rate, inflation rate, and unemployment rate charts, everything is signaling that we're going to see something like probably way back down here, and then we're going to have during that a big old crash this year, next year, something like that, which is pretty scary. And when
you BRICS as well, and rise of China, what does that do?
Exactly, it just exacerbates it, because although this is very US focused, it will affect the rest of the world. Because of the BRICS growing sort of disdain and moving away from the dollar and dollar payment network, etc., and oil trades, everything is just hurting the US. But not to mention that, the US is hurting itself as well. So if you have a look at the auto loan bubble, the student debt bubble, you had a whole bunch of students that didn't have to pay debt, student loan repayments during lockdown and whatnot. Like, everything is just screwed. Now, here's something also pretty damn horrendous. So we all heard of, buy now, pay later type stuff. Well, in the US, there's a really good website called Lending Tree, and it tracks buy now, pay later. So and it does it on a monthly basis. So when we look at April, some of this is just damn right scary, and I will summarize this. How many Americans expect to use buy now, pay later loans this month? So most say no. However, 19% say yes, 17% maybe. And this is just later this month. Mind you, this was updated end of April. So, yeah. And this was from 2,000 consumers early April. So, yeah. Okay. This is a better chart though. In the next 6 months, how many times do you expect to apply for a buy now, pay later loan? So again, most say never, but still, that's a big percentage of people that will apply for it. Not, more than once for a lot of them. How many are late? 4 in 10, so 40%. Interesting. And how confident are you that you can pay it back? So most are very confident. There's always going to be a segment which cannot or will not pay back. Now, I'm just going to go to the summary a bit because it's quite scary. So I've used up-to-date stats to put this into perspective. What this means is that over the next 6 months, 43% of Americans, that's 143 million people, are expecting to use a buy now, pay later loan over the next 6 months. That's a lot of freaking people. 40% of them are likely to be late in paying. So 57.2 million people are going to be late in paying. Just out of curiosity, how many adults in the UK? What is that? So we're about 67 million under that. So let's say, I'm trying to add this up. So 12 plus 15.6. Okay, so from 25 to 59 years, that's 27.6 million. So I don't know, let's say 30 to 35. I mean, this is probably more than the adults that are in the UK, which is crazy. So 57.2 million people are likely to be late in paying. And this is just with a simple teeny weeny buy now, pay later loan. But here's what they're using it to buy. The crazy stat here is that 21% of people taking out these buy now, pay later loans, effectively like a Wonga loan, they're doing it for groceries. How scary is that? 30 million people, that's like half the population of the UK pretty much, are using buy now, pay later loans to buy freaking groceries. Yet when you look at unemployment rate, what's it showing? Oh great, yeah, unemployment's great, isn't it? It's just a massive crock of shit in my opinion.
Simon, is this a change to the past or a new development, or how was that in the past? That would be interesting to see as well, no?
That is a very good point. I'm not sure. But the thing is, I obviously, as you know, my opinion on this, I don't trust these stats at all, because the way they class people as unemployed is stupid. Like you can lose your job and still be looking for a job over, I think, 3 or 6 months period, and you're not counted as unemployed. So these are rubbish. So, I mean, if 30 million people are using loans to buy groceries when things are supposedly rosy, when official stats don't look rosy and it gets back up here, I mean, how many more millions of people are going to be getting it for groceries? Now, obviously, I understand why people get buy now, pay later for TVs and holidays and stuff like that. Dining, I mean, even eating out, getting a loan to eat out, it's not smart. But these people, they're not doing this for shits and giggles, are they? They're doing this to live. What else? Clothing, accessories, purses, home decor, beauty products, meh. Yeah, that is the scary thing for me. So this also means that I think we're going to have a growing contingent of people, and I think this is only going to increase, that like as more people in real terms get onto the poverty line, which those people are, and this is ignoring the people. And by the way, this is people that are eligible for these loans. So again, like with any loan, there's a difference between applying for it and then being granted. So how many millions of people can't even get past the application phase? I would say this number, you know, the amount of people on the poverty line, it would be scary to think. I mean, we look at movies like Mad Max and think, oh, that'll never happen. I think the US is already there. It's just that the US and social media are doing a bloody good job of covering up how screwed everyone is, really. So these are, I guess, middle class civilians, you know, using buy now, pay later loans, and those that are deemed credit worthy enough, that have a job and whatnot, and actually get granted these loans. You know, 30 million of them are still using them for groceries, which is, you know, in my opinion, pretty scary. But yeah, that's a great question of how does it compare to previous times. So if you go on this, it does show you shows you previous months. Where is it? Loans. No, 1 second. Where tracker methodology? No. I'll have to find it another time. It is somewhere on here because they do it every month. So I'm sure one of you can find that pretty quickly. No. But yeah, so I think that's pretty scary. So what else was I looking at? And this just adds to my growing feeling and I guess conclusion that we're not out of the woods yet. I think, like everyone says, this time is different, but I don't know. A lot of the big indicators that seldom fail are all shouting for a 2023-2024 crash in stocks. Yeah, in stocks, let's say. Which, you know, then you have to ask, what about the correlation between stocks and crypto? Again, I think if stocks do tumble, like I've said, for months and months and months, it's just going to drag crypto down. But the other question that is really pounding on my mind is this time, are there going to be exceptions to the rule now? Like, we've started to see little sprouts of decoupling, where Bitcoin starts reacting in a completely opposite way to stocks. You know, bad news in stocks, Bitcoin booms temporarily. So I don't know, there is a growing part of me that thinks, yeah, if we have, you know, even more bank collapses or bailouts or whatever, everything may have like an initial shock and everything goes down 10-20% in a day, but then people go, shit, I can't even trust my banks, my money in, you know, the big banks like JP Morgan anymore or wherever. Where can we go? Not just in America, you know, people in Argentina and other places, they may just go, screw this, yeah, Bitcoin. And then Bitcoin may start to decouple. I think more banking failures is better for Bitcoin. So, but again, this is, you know, your mind must always be fluid. The moment you sort of draw a line in the sand and go, right, this is my belief, you then become no different than a religious fanatic. So, yeah, like you should always be willing to change your opinion based on new data, etc. And then we have, again, going back to the question of how do things compare now to 2008. Well, look at this. I found this on Reddit, but some person actually made this on Reddit, and I've had to add in my own little bubble. But when you add all of the banking collapses in 2007, 2008, so basically all of these bubbles, you're getting to a level where it's pretty much the same. So if, let's say in 2007, 2008, the total amount of crashes is, between sort of 500 to 550 billion. Well, compare that to now. What is this? We can add this up. So 110 plus 209 plus 202, that's $521 billion. So we thought 2008 was bad. We've had 3 big banks go bust, and it's only 5 months into the year, and it's matched the amount of catastrophe that 2008 had. Now, again, I'm well aware that of M2 is just much bigger. So in terms of relative stats, it's still probably quite small. It's just that the currency supply is so much bigger. But we're only 5 months into this, and the crash hasn't fully developed. Now, the other thing that struck me was when I was looking at this. So when I was trying to find where's Bear Stearns and where's Lehman Brothers and whatnot, and the reason being is that Lehman Brothers and Bear Stearns weren't deposit takers. They weren't covered under the FDIC, the Federal Deposits Insurance Corporation. So in reality, this was a much bigger. There should be more bubbles, but this is just banks that took in retail deposits. So, and this leads me to the next thing. How do things compare? Well, when we look at this thing here, so I got this on the Federal Reserve website, and it's basically the impact of rising rates on certain banks, and talking about stress testing and stuff like this. They do this every quarter, and let's have a little read of some of the things here, because it's quite telling. Most banks are generally benefiting from rising interest rates. No shit, because they're gobbling up all of M2 and they're not lending it to anyone. So they're borrowing it for nothing and getting good rates on it. So obviously, net interest margins are expanding and credit quality performance continues to look favourable. Okay. However, rising interest rates are creating significant unrealised losses in investment securities and in some cases depressing tangible equity. Yes, that makes sense. Rising interest rates really does kill property, especially commercial property. So that's that. As interest rates increase, banks with large market value losses could experience increased financial and risk management challenges. Well, yeah, no shit. Look at these 3. And these are not going to be the only 3. I think you'd be pretty damn foolish to think, oh yeah, it's only 3 banks that are going to go bust. We'll sort this out. In reality, what normally happens in stuff like this is that you're going to end up with, basically take all these little small things and then basically add on, it's going to be stuff like this. Because what did we talk about last week and the week before and the week before that? Right now, because of Janet Yellen saying we will basically own, so Yellen, head of the Treasury, basically says too big to fail, bailout, effectively. Not so big, nah. So I still can't find that video, but it is there. So she was being absolutely grilled in some sort of Congress meeting, and basically they were saying that she had to come in and help bail out, SVB, etc., because it was a too big to fail bank, and that a lot of smaller banks that are not so big, they probably won't bail out. So in reality, what's likely to happen is that if you have a smaller regional bank, and by the way, when I say small regional bank, the word small is still going to be deposits of north of 20 billion, north. I'd say 20 to 100 billion. I mean, they are massive banks still. So the word small is a bit silly there. So what this means is that if you corporates and people with lots of money in a small regional bank, they're looking at the risk to reward seesaw and go, okay, so SRB, a small regional bank, the odds of crash and not being bailed out are pretty damn high, whereas a big, like a too big to fail type, what is the risk of that not being bailed out? Pretty low. So of course you can have mass capital outflows from SRBs into too big to fails, which is and also if a relatively big SRB does fail, what's going to happen? One of the too big to fail ones are going to come up and gobble it up like Pac-Man, and we've already seen that happen with JP Morgan, jumping in and gobbling up SRB. And what did we see? We saw Credit Suisse being gobbled up by UBS. Or was the other way around? So I'm getting confused. Credit Suisse went bust. So yeah, UBS came and gobbled it up. But here's the thing. So let's look at this. So if we draw some Pac-Men, and this is JP. We do this. This is UBS. Now, JP Morgan gobbled up First Republic, right? How do they do that? Guess what? The Federal Reserve gave a credit line to JP Morgan so they could gobble it up. Interesting. Okay, who gobbled up Credit Suisse? Or UBS gobbled up Credit Suisse. How did that happen? Well, the Swiss National Bank gave UBS a credit line to help, pay for that gobbling up. But also, what a lot of people don't realise is that there's also an international swap, i.e. a loan, from the Fed.
It's almost like a rigged game, isn't it?
Yeah. I mean, this is crazy, isn't it? So what's actually happening? We're having a stealth, insidious nationalisation of the banks, because the Fed is using the too big to bank fails as sort of like its hitmen to help go and gobble up all the smaller regional banks. Well, not at the moment, but this is Siam's wild guess here, an educated punt. This is the stealth nationalisation of the banking sector orchestrated by the Fed. And when the Fed can't be seen to be helping bail out European banks, what are they going to do? They'll do a little sneaky swap with another central bank, and then that central bank will then go and do the same thing. So we're going to see, very simple. Oh, where's my picture gone? So we had all this in 2008. We're going to have exactly the same this time round, and the too big to fails are just going to gobble up more and more and more and more and more, to the point where you'll have like 4 or 5 banks owning all banks in the US. So yeah, that is my prediction. And why would they do this? Because a lot of people, I don't particularly spend too much time looking on the why. I look at for what's actually happening and whatnot. Well, in my opinion, this is where you do have to get your tinfoil hat out. I personally believe the reason they're doing this stealth nationalisation of the banking sector is because and CBDCs, right? How else can they roll out a Digi Dollar using their FedNow payment network and if there isn't some sort of banking crisis, and if there's so many banks out there that they need to force into it? Well, if the whole of the US banking sector is controlled by 4 of the big banks, and those 4 big banks are hamstrung by the Fed, well, guess what? All of a sudden, the US can easily, effortlessly transition into the Digi Dollar. And that then eventually paves the way for a universal basic income, which then helps out the 30 plus, maybe 100 million people in the US that can't afford to eat. And that also then paves the way into climate change lockdowns, which I promise you will happen. I promise you this will happen. We'll have bullshit carbon credit social score, some sort of like a carbon credit score, which will be linked to which will be linked to the CBDC. So if you go out and buy a fillet of beef, like some beef or whatever, that will then add to your credit score, or your monthly allowance of whatever that is, and then your money will simply not work, and it will not let you buy more beef for that month. Or you're filling up your dirty diesel car with fuel. So you just won't be able to buy stuff, which puts you over the carbon credit scoring system. But they can't do all this until they have UBIs and CBDCs and stuff like that. And you must never forget that ESG was a whole concept that is actually created by BlackRock. BlackRock created ESG, and that is how I think the private sector are going to somewhat control the world via ESG. Now, I'd like to play this. We all go back to the markets, but let's just listen to this chat.
Who will really command the fourth industrial revolution and its technology like artificial
intelligence? Slow down, Klaus. 1%. Yeah, one time speed. Here we go.
What's your sense of who's best placed at this time to lead the world into the fourth industrial revolution? Because you pretty much created this term. We're seeing the kind of technological strides that China has made with Huawei, with the 5G technology. Do you believe that this could potentially be China's time once again?
We should make here again let's say a differentiation. On the one hand, we have state capitalism. On the other hand, we have shareholder or private capitalism. So it's a clash between two systems. I believe that state capitalism in the short term provides certain advantages, because you can mobilize in a concentrated way a lot of resources to reach a specific objective. But I believe that the future is not state capitalism or shareholder capitalism. The future is what I call stakeholder capitalism, which is combined with a social responsibility.
Yeah, just keep an eye on that, okay? So, where does this lead us? The banks are screwed. Or the small regional banks, and all these little dots. It's going to be, I think it's going to be well north of $1 trillion by the time this all plays out. So, let's go back to the 100%. What else can we talk about on this topic? How many adults? No, don't need that. I want to make sure. Oh yeah, we're going through this. This is, so I've got sidetracked here. So, deposit surge, securities increase during pandemic. Yep, that's fine. Here we go. Unrealized losses are at high levels. As interest rates rose during 2022, the market value of bank securities significantly declined, creating unrealized losses. Unrealized losses are highest at banks with long duration securities and or large securities portfolios. So let's talk about this for a second. So, why can I not highlight it? So, what a lot of banks did is, like especially Silicon Valley banks. So typically you have the Fed over here, and the Fed has, let's say a big old checkbook or whatever, and a bank, I don't know, let's just take Silicon Valley Bank. They'll have some sort of credit line, okay? And they'll have an account. So their account is this much, I don't know, X amount of billion, however much, doesn't matter. And so they can borrow at the Fed funds rate effectively, plus, a little bit. So let's just say it's, for as long as we can remember, it's been like, 0% or 0.1%. So let's just say they can borrow money effectively for free. So what then SVB have gone, and other banks, not just them, but I would say hundreds of other banks have gone, free money. So what can we do with all this free money? Yeah, we'll just put it in some, long-term treasuries and stuff like that. And other long-term shizzle, right? We're talking, 10-year plus investments. And so what's happening now? So they're getting a yield. So if you look at something like, if we get the 20-year out, so US 20, sorry, the yield, I want US 20 yield. It's paying about 3.8% at the moment. So they can effectively get, let's just say 3.8% from that coupon. But what's the Fed funds rate right now? And it's close to 5%, or what is it, 5.08%. And so what they're being hammered by the interest repayments back to the Fed, because they've got a negative delta of, say, 1.2%. And I'm really broad brushing this, but you get the gist. They've borrowed money for, on, let's say, a variable rate interest rate. They've put it into really long-term stuff, and now rates are jumping up, and they're killing the banks because of the interest repayments, etc. So that's what it means by where are we? This bit here, unrealized losses, because that's effectively what it is, are highest at banks with long duration securities and or large securities portfolios. Banks reporting large unrealized losses may have limited ability to sell securities to fund loan demand or support unanticipated deposit withdrawals without recognizing losses. So not just that, not just are they getting absolutely slaughtered by interest rates, smart investors that may invest in this bank like SVB, etc. And by the way, a lot of these are unhedged because they're old crusty fat cat banker wankers going, investing in the government, you can't go wrong, all that sort of stuff. And so they're just like, there is no risk, so they completely unhedge it. Or what do smart investors do? They see all these unrealized losses and they go, oh, shit, they're up shit's creek. Let's take our money out. So you then have massive outflows of depositors. Unanticipated deposit withdrawals without recognizing losses. So let's look at the chart now. Unrealized gain / loss on investment securities is it's worse than it's pretty much ever been. A growing number.
Does this affect currency contraction?
I do, yes, I do.
Yeah.
A growing number of temporarily. I temporarily expect it.
Yeah.
So I think it will go down for a bit, and then then they'll drop rates close to zero and try and pump their way out of oblivion. A growing number of at third quarter end, 722 banks reported unrealized losses exceeding 50% of capital. Basically, see all these little dots? There's not as many these days as there were in 2008, but I think all of these little dots are basically those 720. Yeah, so I would actually draw 722 little dots around these big old crashes, and I think they're the ones that are going to be gobbled up by the too big to fail banks. 31 of these banks report negative tangible equity levels. Banks reporting negative tangible equity are currently not able to borrow new money from federal home loan banks and may lose the ability to sell loans to government-sponsored enterprises. Yeah, this is not good. So, banks with large unrealized losses, i.e. those 722, they're screwed basically. When you read through this, I don't want to go line by line because it's boring for everyone. Long story short, I'm pretty sure they're going to get bailed out. Oh, not bailed out, bought out, gobbled up by a bigger bank. So
the gobbling up of other banks can't go on forever because they soon realise that they become vulnerable by the bigger they get.
Yeah, and guess what? This is almost identical to the subprime mortgage collapse, isn't it? You had a whole bunch of dodgy collateralized debt obligations, CDOs, and then they were just repackaging them into, they're taking junk bonds, repackaging them into, better bonds. Like The Big Short, the analogy The Big Short used was that they had old fish soup that had gone out of date, so they just lump it in with new fish soup and then sell that. So yeah, example SVB, etc., etc., etc. I think that's quite telling. So we've got shitloads of big banks, I think soon to be gobbled up, and like Chris correctly said, it can't go on forever. So yeah, and this all leads. So like Adam asked, what do I think is going to happen with M2? I think it's going to be, this M2 is doing this. I think it's going to have another sharp drop followed by YOLO to the moon. And during that, we're going to have basically full nationalization. Well, let's say stealth. Nationalization. I mean, we got the term government sacks for Goldman Sachs, and it's basically the same thing, except it's JP Morgan now, so it's government Morgan, or whatever term you want to be. So they'll all be gobbled up, and then at some point maybe there'll be a debt jubilee of some sort. I mean, history has shown us debt jubilees happen all the time. I don't know how that's going to work, but if that does happen, it's going to coincide with CBDCs.